Imagine a country where the money sent home by workers abroad exceeds the actual growth of its entire economy, where the lifeline isn't factories, tech hubs, or natural resources, but envelopes of cash crossing borders from distant cities. This isn't a hypothetical scenario. It's the economic reality for several nations around the world. And it raises a question that economists, policymakers, and families alike grapple with every single day. What happens when your economy depends more on what your citizens earn overseas than what they produce at home? To understand this, we need to start with the basics. What exactly is a remittance economy? And why does it matter so much? A remittance economy is one in which a significant portion of national income comes from money sent back by migrant workers living and working abroad. These funds, known as remittances, flow into households through banks, money transfer services, and increasingly, digital platforms. And they're used for everything: daily groceries, school fees, healthcare, housing, and even starting small businesses. For many developing nations, remittances represent the single largest source of foreign exchange, often dwarfing foreign direct investment, official development assistance, and export earnings combined. According to recent World Bank data, global remittances to low and middle-income countries reached over $500 billion annually in recent years. And for some nations, these inflows account for 20, 30, or even 40% of their gross domestic product. Let that sink in. That means nearly half of the money circulating in some economies comes not from local production, but from the sweat and sacrifice of workers thousands of miles away. So, which countries are we talking about? The list is sobering and spans continents. Tajikistan, a landlocked nation in Central Asia, consistently ranks at the top, with remittances accounting for more than a quarter of its GDP in recent years, driven largely by Tajik workers in Russia. Tonga, a small island nation in the Pacific, sees remittances make up nearly 40% of its economy, as Tongans working in Australia, New Zealand, and the United States send money home to support extended families. Lebanon, despite its ongoing financial crisis, relies heavily on remittances from its vast diaspora, with billions flowing in annually to stabilize households even as the banking system teeters. El Salvador, Nepal, Honduras, Haiti, the Kyrgyz Republic, and the Gambia all share this dependency, with remittance to GDP ratios consistently hovering between 15 and 35%. Even larger economies like the Philippines, India, Mexico, and Pakistan receive tens of billions of dollars in remittances each year, though as a percentage of GDP, the figure is lower simply because their economies are more diversified. But make no mistake, for millions of families in these countries, remittances aren't supplementary income, they're survival. Now, why does this dependency exist in the first place? The answer lies in a global labor market that is deeply unequal. Many of these remittance-heavy nations have young, growing populations but limited domestic job opportunities, weak industrial bases, political instability, or a combination of all three. Let me paint you a picture. When a young man in Nepal can't find work that pays enough to support his family, he migrates to Qatar or Malaysia to work on construction sites. He sends home a few $100s each month, money that, in his home village, can mean the difference between poverty and stability. When a nurse from the Philippines works grueling shifts in a hospital in Saudi Arabia or the United States, the remittances she sends back pay for her children's education, her parents' medicine, perhaps even a new roof on the family home. This is the human side of remittance economics: sacrifice, separation, and resilience. But it's also a structural trap, because the more a country depends on remittances, the less incentive there is to build strong domestic industries, invest in infrastructure, or create jobs at home. And that brings us to a critical question. Why isn't this model sustainable in the long run? On the surface, remittances seem like a blessing. They reduce poverty, increase household consumption, smooth out income shocks, and inject billions of dollars into economies that desperately need foreign currency. Studies have shown that remittances help families afford better health care, keep children in school longer, and even weather natural disasters more effectively. But there's a darker side to this dependency. First, remittances are inherently volatile and vulnerable to external shocks. When a global recession hits, migrant workers are often the first to lose their jobs, and remittance flows dry up overnight. During the COVID-19 pandemic, for example, Remittances to some countries dropped sharply as borders closed, industries shut down, and millions of migrant workers either returned home or found themselves stranded without income. Second, remittances don't generate productivity in the same way that investments in manufacturing, technology, or infrastructure do. When a family receives remittance money, they typically spend it on consumption, food, clothing, healthcare, education, which is important for well-being, but doesn't create new industries, jobs, or exports. In other words, remittances keep people afloat, but they don't build the economic engine that could eventually make those remittances unnecessary. Third, and perhaps most insidiously, a remittance-driven economy can actually discourage work and entrepreneurship at home. If a household knows that money will arrive from abroad each month, there's less pressure to seek local employment or start a business, especially if local wages are low and opportunities scarce. This dynamic, sometimes called remittance dependency syndrome, can weaken labor force participation and stifle innovation. And then there's the issue of exchange rate distortion and inflation. When billions of dollars in remittances flood into a small economy, they increase demand for goods and services without a corresponding increase in domestic production. This can drive up prices, especially for housing, food, and other essentials. This inflationary pressure hits non-remittance receiving households the hardest, widening inequality and creating resentment. Moreover, large remittance inflows can cause the local currency to appreciate, making exports less competitive on the global market. Economists call this Dutch disease, and it's a real risk for remittance-heavy nations. Now let's talk about the dollar shortage versus remittance inflow dynamic, because this is where things get particularly tricky for policymakers. Many remittance-dependent countries also face chronic foreign exchange shortages, meaning they don't have enough dollars, euros, or other hard currencies to pay for imports like fuel, medicine, machinery, and food. You'd think that billions of dollars in remittances would solve this problem, but it doesn't always work that way. Here's why. Remittances typically flow directly to households through private channels, banks, money transfer operators, mobile wallets, and households spend that money on consumption, often on imported goods. So while remittances do bring foreign currency into the country, much of it leaks back out almost immediately to pay for imports, leaving the central bank and government with limited foreign reserves to manage the broader economy. In some cases, governments try to capture remittance dollars by offering incentives for migrants to send money through official channels, or by requiring currency conversion at official exchange rates. But these policies can backfire, pushing remittances into informal, unregulated channels where they're harder to track and tax. And if a country is already facing a balance of payments crisis, remittances can provide temporary relief, but won't fix the underlying structural problems. Weak export sectors, high import dependency, unsustainable debt, and poor governance. Which brings us to the long-term risks, and these are significant. Risk number 1. Brain drain. When a country's most educated, skilled, and ambitious workers leave to earn higher wages abroad, the domestic economy loses not just labor, but talent, innovation, and leadership. Doctors, engineers, teachers, nurses, and entrepreneurs who could be building hospitals, schools, companies, and infrastructure at home are instead filling gaps in wealthier countries' labor markets. Over time, this exodus hollows out the professional class, weakens institutions, and makes it even harder for the country to develop. And while remittances provide financial compensation to families, they don't replace the human capital lost. Risk number 2. The demographic time bomb. Many remittance-heavy countries are experiencing rapid population growth, and if job creation doesn't keep pace, the pressure to migrate will only intensify, perpetuating the cycle of dependency. Meanwhile, aging populations in traditional destination countries like Japan, South Korea, and parts of Europe are tightening immigration policies, which means fewer opportunities for future migrants and potentially declining remittance flows. Risk number 3. Geopolitical and policy shifts. If a major destination country imposes stricter visa rules, cracks down on undocumented workers, or experiences its own economic downturn, millions of migrants could be forced to return home, and remittances could plummet, triggering economic and social crises. Risk number 4. Inflation pressure. As mentioned earlier, this can create a vicious cycle. Remittances push up prices, making life more expensive for everyone, which in turn increases the pressure on families to seek remittances from abroad. And the cycle continues. And finally, risk number 5, the opportunity cost. Every year a country spends relying on remittances is a year not spent building the industries, infrastructure, and institutions that could eventually make the country self-sufficient. It's a tough reality, but it's one that leaders in remittance-heavy nations must confront. So what's the way forward? Experts generally agree that while remittances can play a positive role in reducing poverty and smoothing consumption, they should never be seen as a substitute for long-term economic development. Governments need to invest in education, vocational training, infrastructure, and business-friendly policies that create jobs at home. They need to diversify their economies, reduce import dependency, and build export sectors that can earn foreign currency sustainably. They need to create incentives for the diaspora to invest in businesses and projects back home, not just send money for consumption. And they need to think seriously about how to retain talent, how to create a future where young people don't have to leave their families and communities behind just to make a living. None of this is easy, and it requires political will, smart policy, and often difficult trade-offs. But the alternative, an economy perpetually dependent on the earnings of workers abroad, is a fragile foundation, vulnerable to global shocks, demographic shifts, and the whims of foreign governments. For the countries where remittance inflows exceed GDP growth, the message is clear. The money coming in from abroad is a lifeline today, but it cannot be the strategy for tomorrow. Building a resilient, self-sustaining economy requires looking inward, investing in people and potential, and recognizing that true prosperity comes not from what citizens earn elsewhere, but from what they can create, build, and achieve at home. And that's something worth remembering when we talk about the future of work, migration, and economic development in an increasingly interconnected world. What do you think? Should countries focus more on creating domestic opportunities, or are remittances a necessary bridge? Let me know in the comments below. And if you found this video insightful, don't forget to like, subscribe, and hit the notification bell for more deep dives into global economics.